Tom, thank you very much for your warm welcome. Good morning. Thanks again to those of you who've decided at least to come to the early session before the cricket starts. We'll be as brief as we can. I'd perhaps say a few things and then invite each of these esteemed panelists to spend a minute on who they are, who they represent, and perhaps a word on their background insofar as it relates to the topic, which is what is the hallmark of a good investment? I suppose certainly in the seat which I currently occupy, running our natural resources group in various parts of the world, the last 5 or 10 years, for me, particularly taking a broader perspective on the periodic table from a nat res perspective, has been difficult for the sector. And I think, in general, one of the hallmarks of the experience has been the lack of capital available to be invested. And that's been, within the players in the sector, a function of much diminished free cash flow for various reasons. But external to the sector, I think there's been a dramatic reduction of risk appetite and capital allocation, perhaps linked to the first point, from all quarters, starting with the project financing community and the banking world, all the way through to the private and the public financial investors, all those represented by two of our panelists here today. So I think as we think about particularly the attendees and the focus of this conference, really at the sharp end of the best ideas of growth in the mining sector, it certainly occurs to me as I travel the world that it must be very difficult for the management teams represented here today to, even ostensibly with the best hand-picked projects represented here in the room, to persuade people to allocate capital to their businesses. And so it's very much in that spirit that I'd like to interrogate our esteemed panelists here as to how they think about good investments. Why don't we start with you, Tal, on my right? Perhaps just a few words of introduction before we get going.
Sure. Well, thanks to the Mining Journal for having me here and for putting this panel on. So I'm Tal Lomnitzer. I am a senior investment manager at Janus Henderson on the natural resources team. We run about $1 billion invested across the resources sector. That's mining, energy, as well as soft commodities, ags, and nutrition. Our firm is very committed to this space. Unlike others where capital has been exiting the space, Janus is looking to build. And we've been finding pretty good reception amongst investors. We're seeing pretty decent flows. Not like it used to be in the heady days of the China bull market, but we're seeing quite sustainable flows coming in from investors that are taking a longer-term perspective on the space, seeing growing demand for commodities and finite supply. We are in a mode of looking for new investments as we sort of reseed the portfolio and look to the next 3 to 5 years.
Thank you. Olga?
Okay. Thank you for having me as well. My name is Olga Antonovskaya. I am head of mergers and acquisitions for BHP London M&A team. We also have a team in Australia. I've been with BHP for soon 15 years. And during this time have been involved in different aspects of portfolio management, including strategy, business development, investment evaluation, acquisitions and divestments. So hopefully we'll be able to contribute to this discussion. And I guess for the purposes of this panel, I represent strategic corporate investment with a multi-decade investment horizon.
Yeah, Bert, Koth. I'm the private equity representative on this panel. I'm a partner in Denham Capital's mining investment program. Denham is a US private equity firm, $9 billion AUM. Our mining franchise is a little bit shy of $2 billion US. What we do is what we regard as real private equity. So basically, the way how we invest in metals and mining is basically a replay of how the US oil and gas private equity space works, which is a backer management team approach. That means we start with the people first before they have the assets. So we spend a lot of time business planning with potential management teams, analyzing potential management teams. And then when we are comfortable with a management team and the management team is comfortable with us, then we go out together with that management team and seek to take control of assets that resemble very strongly to what that management team has successfully executed before. Our typical entry point is a project that is relatively close to development ready, say realistically 2 to 2.5 years maximum away from production. We either outright acquire that project or we earn with our management teams into control position, assume the execution risk, which is, by the way, a very difficult risk to assume, and then when the project is up and running and cash flowing, then we typically auction it off to the highest bidder. This is how we make our money. So it's a very classical private equity strategy. With a very few exceptions, we almost completely avoid the public markets. It's called private equity for a reason.
Well, Bert, if you like, I'd like to start with you to pick up on your comments. I think, as you've described it, you're really investing in, if you like, growth in the metals and mining sector. And
I invest in people first and foremost.
And people who, you know, who ultimately creating new production, creating value through riding the value curve of taking assets through that cycle. How much do you think about your exit when you allocate capital at the outset?
When you don't know how to get out, you shouldn't be getting in. So that's literally one of the first boxes to be ticked. We take a view that upon successful execution of the business plan, we got to have an M&A liquid exit, an M&A liquid asset, and if we're not convinced that we'll have that, then we're not investing in the first place. And the focus is on M&A exit liquidity. We're not interested in listing the stuff. We've done that once or twice before, and in each case it was the wrong decision to do so. Because we're such a large shareholder, then you escrowed for 2 years, then the market sentiment can change, blah, 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 blah. So we just found the most efficient way for us to make our money is just to sell it to whoever pays us most in cash, and that's it.
So you talk about investing in management teams, but the underlying asset quality then has to be of a
Absolutely.
certain standard. How do you think about that?
Well, I mean, what I'm going to say now is not going to come as a surprise to anyone. So if anybody gets bored, please raise your hands. It always has to be low on the cost curve. The capital intensity needs to be low. It should be an asset of some scale. It should have some embedded optionality. Ideally, there's, for example, in a low price environment, maybe in a cold deposit, maybe can kind of refocus on some lower strip ratio calls, so embedded optionality, low on the cost curve, as much de-risked as possible, but these are all obvious bullet points. And even now, and you mentioned there's just not a lot of money in the room, I take a very maybe controversial view. I would argue that there's still today too much money in the room because we actually still see quite a lot of capital misallocated in assets and developments that actually shouldn't be funded. Yeah, no names obviously, but so you only have discipline in the industry when you have real capital scarcity, when every single dollar matters. I mean, when the super cycle ended, the mining industry globally lost approximately $600 billion. That's more or less the same loss of capital that you had as a loss when the mortgage-backed security crisis in the US hit. So the mining industry has destroyed as much capital as the mortgage-backed security crisis in the United States. And the reason for that is that when there's too much money in the room, the discipline and the rigor gets lost. The less money there's in the room, the better the decision-making becomes.
So with two of the biggest mining companies effectively represented in the room today, if I may turn to Olga, I remember at the first trimester of my career being educated on the mantra of tier one assets in the halls of BHP Billiton as it was then. As you described your institution as a multi-decadal investor, how do you think about asset quality?
Well, tier one asset, I guess, is the basis of our company and how we've been built on and how we still look at the investments. And as Bert said, there are no surprises there. It's still about large market, long life, low cost, expendable assets. It's still pretty much the core of our strategy. and our kind of view of the future.
The problem is there are not many of those around.
There are not.
You took the question out of my mouth. So is there a new definition of a tier one asset, would you say, or is that at risk of making the same mistakes that Bert referred to?
I think the shift that we've been kind of seeing is maybe the move from tier one assets as such to tier one businesses, or world-class businesses, as we call them. And this is where, it doesn't have to be one asset, it can be a number of assets that would, in combination or together, would still meet our key strategic requirements.
So before we come on to Tal to talk about a public market perspective, Olga, you've obviously had many different roles within the organization. So sort of taking all of that into account, do you think your shareholders are ready for BHP to start investing for growth, for volume growth at this point in the cycle?
We hope so, and I think as part of this dialogue with the shareholders, we've been doing, including recently, we've been engaging with shareholders about our strategy and our famous capital allocation framework. So I think this is all part of keeping the dialogue open with the shareholders and understanding what the appetite is.
So Tal, if I may turn to you, we were chatting outside earlier and there were two comments that struck me, well, maybe three, I think, to state perhaps what might otherwise be obvious. I'm still surprised that there's specialist mining/natural resources investors and funds out there. So that was a pleasant surprise for me. But two of the things that you said, perhaps in light of that, were less surprising, but still stood out. One is, as you think across the portfolio of assets, are you spending any time looking at early stage mining companies, mid-cap early stage mining companies? And the second comment you made was, as it relates to the funds in the ecosystem which you occupy, the interest of the generalist fund managers and what you do was really around the yield offerings that some of the larger companies are providing. I'd love for you to comment on those two aspects before we get into the detail.
So one of the things that surprised me when I joined Janus, which was about 4 months ago, having previously worked at First State Investments and running the resources funds there, was with a broader sort of audience of potential investors internally, how much interest there was from income guys, attracted by dividend yields in the 4-5% range, with incremental share buybacks in the 4-5% range, and then potentially even 4-5% free cash flow to put to growth. So I think that's quite a big shift relative to what I've historically seen in the 20 years or so that I've been doing this. So, there's a sustainable pool of money out there that will invest in, and this more relates to the BHPs and the larger companies of the world. We still feel that there is a big space for growth and the world needs more resources. And so what we're looking for at the moment is companies in the smaller and mid-cap space that are looking to put new projects into the market. We still have a foundation in the portfolio, about 50% of the portfolio in the very large cap companies, but we're looking to grow the tail, if you like, of smaller cap investments. We will go down the market cap spectrum. We tend to be shy of going below 200 million. Our funds are listed funds, daily liquidity, so we do have to be mindful of getting too exposed in the smaller cap arena. And one of the things that we've come to appreciate over time is how quickly liquidity can dry up. So we tend to be very cautious on that front. We don't take very large positions in companies, but we will prefer to go down a route of having a tail of options in the portfolio. I was quite encouraged by what Bert said about exits, actually. That really resonated with me. One of the things that we tend to find quite off-putting is when a company comes to market with a very large private equity sponsor who's putting a small percentage of the company into the market, that tends to merely cap the upside going forward. And it's quite nice to hear that that perspective comes into play right
The
at the
overhang
beginning.
kills it.
Yeah, so we've seen that repeatedly. Really good businesses with great assets, where I mean ultimately share prices are a function of demand and supply, and when you've got a 60% overhang coming to market, that tends to do one thing to the price, which is hold it back.
So perhaps just to turn in a slightly different direction and talk about a couple of overarching themes that might drive your decisions respectively, and then perhaps we can open it up a bit more for a discussion. So in no particular order, welcome comments. Are there particular, we've talked about the asset-specific considerations that drive a good investment, and we've talked about obviously the importance of good management, but beyond and above that, are there themes that you see driving value in, multi-decadal themes even, that you see driving different value according to the different metals and minerals in the sectors that you look at?
Well, if I may jump in on that, one of the big themes that's rolling through the market at the moment is a focus on sustainability, environmental, social, and governance factors. And so having a great asset, a tier one asset with low costs and long life, is obviously critical to the importance to the survival and success of a company. But we're now seeing sort of non-financial considerations becoming much more important, and it's becoming sort of self-fulfilling as companies that focus more on the environmental, social, and governance side of the business are attracting more capital, and then their share prices do better, which attracts more capital. So there is something self-fulfilling going on there at the moment, at least. So that's one sort of quality factor that I think is quite often underrepresented. The other two, which we focus on are jurisdiction. We're finding it increasingly difficult in certain countries for mining companies to extract a decent amount of economic rent without having a big bite being taken out of it. And then balance sheet. Having a great asset is important, but knowing how to manage the balance sheet is quite often overlooked. And if I look back on all the failures of my investment career, they've all been related to companies that have had excessive debt.
I guess maybe to add to Tal's point, sustainability, I guess, is almost a precondition to everything we do and the way we look at the assets. So it's kind of where we start, that it has to be there. And in terms of how we think about future investments and value, I guess everything starts with a strategy. We run a number of what we call divergent scenarios, which with the objective to identify the long-term trends, and some of the themes we are looking at would be, as discussed actually yesterday morning here in the Global Outlook and second presentation, electrification, of course, of the transport, decarbonization, water stewardship, etc., etc. Based on these scenarios, we then test our existing portfolio, but also identify the potential gaps in our future portfolios that would allow us to, sustain, not only survive, but also maximize cash flows and increase value returns to the shareholders in the future. And so based on this, for example, we identified that we would have appetite for more growth options in copper, in nickel, and in conventional oil. We also believe that a company like us should have a suite, if you want, on different types of growth options. And so based on the growth options that we have at the moment, we are interested in more early stage, high risk, high return options for the future. So this is, I guess, and then of course, on top of this, there is a capital allocation where all these options need to compete against each other and against returns to the shareholders.
So some of that must have been music to Bert's ears. Any additional comments?
Got themes. Resource nationalism is a concern because you actually have now the counterintuitive situation that in some of the riskier parts of the planet, your actual equity returns are actually below places like Canada and Australia, for example, right? because of ever-increasing government expectation. Africa is a good example. I mean, the typically achieved equity returns that we have in Africa are significantly below Australia and Canada at the moment, all other things being equal. So, and that's not how it should be. It should be just literally the other way around. Then one other one is because we're so focused on management, we spend a kind of excessive amount of time just screening management teams and management talent. To give you an example, we've business planned with more than 400 management teams over the last decade, and backing up 8 with capital. Yeah? And the issue is, in an industry that is anyway has a really poor management quality overall, right? You actually, there's less and less people actually kind of filling up the pipeline of talent behind. Like in Australia, I found it hard to believe the other day, right? There's only 12 metallurgical engineering graduates per year, right? On such a large industry, right? And then a lot of the people who graduate from university, like in mineral economics, the first thing they want to do is to work in a bank or a brokerage. They don't even want to go out in the field or build a mine or drill and explore. So the people who actually really know what they're doing, yes, anyway, not that many already, right? Sorry if I think, but that's how we perceive it as investors, right? And then getting less and less and less. So that is actually for us, when I look on a kind of, let's say, a 10-year forward planning with our franchise, right, that's a huge concern for us, right, that we actually see this erosion in the human resources and in the talent pipeline. The other thing is when I speak at conferences like that, people very often expect me, what do you think about electrification here? And so we don't believe in hockey sticks, right? So whenever a forecast looks too good to be true, when it's a hockey stick, it usually doesn't happen. I mean, you just go back, whatever, 2006, the uranium bubble, boom, look where it is today, right? Then you go back, whichever year it was, like 2011 with the earth prices, boom, just look where we are today, right? Then in 2009, the potash price was like 4 times higher. Then look where we are today. So whenever there's a huge body of research out there that forecasts a hockey stick, usually the supply responds to the hockey stick, and then the hockey stick that doesn't happen.
I'd like to pick up on one of the comments. In a sense, each of you and the constituencies you represent today have a license to operate by the grace of probably the same portfolio of pension funds at the end of the day, to whom or from whom you get your capital or your ability to allocate the capital that you have in your management. On the environmental theme in particular, and it feels like under the banner of climate change, the carbon theme seems to be the one that's getting the most attention. Do you feel that asset prescription is either coming by choice or being imposed upon you by the people who allocate capital to you?
Sorry.
So as a prescription in the sense that you will be told that you may not own certain types of assets, for example, under the carbon banner, but not, I imagine, exclusively on that basis.
There is that trend, sorry for jump, because we've just come off another fundraise. We've had a lot of these discussions with our investors. So there is definitely a trend for increasing prescription, right? What people want investors to do. Now, I'm personally a fan of self-regulation because the community and the environment are really your operating license. Yeah. So you anyway need to deliver a best-in-the-class environmental and community job wherever you go today, right? Because otherwise you do not have a project, right? You can have the most beautiful feasibility study in Excel spreadsheet in the world. If you compete with a rural community in Peru for water, you have no project. And the rest doesn't matter anymore, right? So you in any case have to always do the best thing that you can and really do the right thing for the community and the environment wherever you go. Otherwise, you have no project in reality, right? So in my opinion, it doesn't require prescription. But there's definitely an increasing trend towards prescription here with ESG guidelines, et cetera, which is not yet happening that much in mining private equity, but I'm pretty sure it's going to come in another 1 or 2 fundraising cycles. So there's definitely that going on.
Well, from our perspective, in terms of prescription, we don't really see that, albeit coal is very difficult to invest in, for example. We have no pure coal investments in the portfolio. The only exposure we have to that is through larger companies that have increasingly de-emphasized coal, in particular thermal coal. We still see a big need and demand for metallurgical coking coal. And one of the things we find a little frustrating is that with all the focus on UN Sustainable Development Goals and all the noise that has generated, a lot of investors are shying away from the necessary ingredients to facilitate that development. So we're quite happy to invest in what are considered to be somewhat dirtier providers of development materials like steel from blast furnaces. As long as the company is aware of the carbon footprint that they have and is making an effort to reduce the greenhouse gas emissions associated with that. There are a lot of ways of doing that. So yes, it's an important thematic, the carbon thematic, but we're sort of coming at it more from the perspective of facilitating the transition to a world which is more electrified, less carbon intensive. In terms of prescription, though, we're not seeing very onerous prescription, albeit I have run a fund in the past for a very large European pension fund which had a carbon footprint ceiling on it. And that was a real first from our perspective.
I guess just to add to those points, from our perspective, again, it goes down to strategy. And then strategy reflects all these recurring themes, including decarbonization, including, license to operate, sustainability, et cetera, and then put into the strategic kind of context, and then with capital allocation underpinning the strategic considerations. I guess that's kind of how the selection happens. So it is part of the process, but it's not prescription as such. It's part of consideration, but it's not.
I think this is an additional challenge, if you like, for smaller companies who perhaps don't have the resources to address some of these big questions and some of these big, if you like, consequences of the things that mining companies do. We at Barclays certainly have spent a lot of time debating this in the last 2 years that I've been in the seat, and as much as the science is providing a lot of evidence, there's obviously a groundswell of interest in this topic, and the confluence of, if you like, the popular opinion, particularly around climate change, and the allocation of financial assets to be invested within certain guidelines is an intersection that personally I see coming, and possibly sooner than people.
I need to tell a story here without saying names. Sorry for interrupting. In our fundraise, we had to provide to one of our investors an independent expert study that explains why metallurgical coal is indispensable for renewable energy.
For example?
That was necessary to unlock the funding. So it was really a discussion, okay, 1 megawatt of installed wind energy, and that comes as a surprise to a lot of people, requires between 80 and 90 tons of metallurgical coal. 1 megawatt of installed solar energy, because the solar panel unfortunately doesn't grow on a tree, it's made out of steel, requires between 700 and 800 tons of metallurgical coal. So, and then the debate is, so you guys are comfortable in funding wind farms? Yeah, absolutely. You're comfortable in funding solar farms? Absolutely. How many megawatts is that solar farm over here in the desert? Okay. Calculator, congratulations, you got that many tons of metallurgical coal in your portfolio already. And that is something that people really just do not understand. The stuff doesn't grow on trees, unfortunately.
So, just to lighten the tone a bit, a question for each of you to answer, and then we can open it up for the audience. Insofar as you're comfortable disclosing, best investment ever and worst investment ever.
Let's start with him first.
Mine are much more measurable, unfortunately. A real success for us, which is a name that's probably familiar to quite a few, would be Eero Copper. And the reason I raise it is because it does fit the profile of what we look for very nicely. High grade, a reasonably safe jurisdiction in Brazil. From our perspective, a management team that we'd known for a very long time and had followed through various companies that they'd been involved with. Brownfield expansion capacity, and access to liquidity and funding. Mm-hmm. That pretty much ticks every box from our perspective. When you throw in a short reserve life, but really interesting geology, which could easily expand the resource life, and every additional year of My life there was an incremental addition to the NAV before even looking regionally at the exploration. It sort of had everything that we would be looking for. So we participated quite strongly in that IPO. Whilst there was some private equity overhang there, it was in the region of 15, 16%, not 50 or 60%.
Sure.
I can't talk about a good investment without shying away from a bad investment. As I say, the bad ones that I recall have all been linked by having excessive debt on the balance sheet. Unfortunately, we got caught out by Canada Lithium, which again had a lot of the hallmarks we would look for: good access to capital, looked like good management, part of the Lundin group, safe jurisdiction, but ultimately had too much debt and couldn't get the chemistry set to work and ended up sinking.
Any other contributions?
Okay. Well, we have quite a number that work out well, so I'm kind of, I don't want to do injustice to the ones that I don't mention, but probably our best one is our metallurgical coal team in Australia, the former Gloucester coal team who we're backing. They acquired Australia's third largest hard coking coal reserves from Peabody, the Olive Downs complex. That's about 600 million tons of proven and probable open pitable hard coking coal with existing rail and port allocations, actually a BHP Billiton type asset, actually in reality, that normally doesn't find its way into private equity hands. And we at the moment working towards developing that. So we haven't monetized that yet, but this one really looks like it's going to be a fund maker for us. Knock on wood, don't want to jinx it. And we acquired that for $90 million US. So at approximately 5% of net present value, on the much lower consensus price tag that you had at the time when we acquired it. I would say where we have gone wrong, rather than nominating one company in particular, because there are probably 2 or 3 examples in our portfolio, is where we assumed too early stage risks, because at the end of the day, exploration is a zero-sum game. And I've lost count of the geologists who tell me, I know it's there, we know it's there. Well, you only know once you've drilled it. And I think this is where we probably have kind of spent too much capital on binary risk outcomes. Nothing that really kind of affects the portfolio on a larger degree, because it's such a lot. It's at the end of the day, you take a portfolio theoretical approach on things. But it was interesting to see, even if you back teams of regional geologists who really operate in their own backyard, where they have been operating for the past 20, 30 years, even in that case, it is still a little bit going to the casino, despite the best judgment calls, interpretation, and everything. So this is why I think just overall, early stage risk just is not very amenable for private equity, in my opinion, because when we raise money, I mean, think about it like you go out and get a really expensive mortgage, right? So you have an IRR cost of capital clock in a compounding manner of 8% per annum ticking against you, right? Then you overlay that with fund G&A and all that stuff, right? So more or less you have 10% cost of capital compounding against you, right? So after 5 or 6 years, you have to return 1.6 times of your money to your investors before you yourself make any profit, right? To expose that expensive mortgage to basically binary outcome risks in early stage is probably not the best allocation of capital. So rather than saying this is the one bad company in our portfolio or something like that, I would say there's probably 2 or 3 smaller ones, teams that we backed for early stage stuff, and that was just not such a great experience.
I guess from BHP perspective, the good investments have been the ones that, let's say, we acquired and then subsequently kind of converted value through execution of the embedded options that we like so much, and they are very part of our tier 1 definition. And so where we managed to realize these embedded options and also add value through kind of operating these assets efficiently, or de-risking this asset, this is what creates value. That's where the value was maximized, and I guess Escondido or Gulf of Mexico are the examples. In terms of maybe not the worst investments, but where we definitely learned a lot of lessons, I guess this is shale. which we already successfully divested. But this is an example where, by looking at a single point hurdle rate, you can really kind of potentially go wrong. And this, if you look at shale, this is where deterministic NPV at the moment was very high, but then some other metrics like capital efficiency or like all-in cash costs and margins probably were not as attractive as we hoped it would be. Well, and lack of growth optionality.
And what's interesting about the unconventional shale business is how certainly in the last 3 years we've been through the same cycle that the majors across oil and gas and mining, and of course the mid-tier players have all been subjected to by the market, which is a reversion to the first principles of you generate free cash flow. Is that free cash flow commensurate with the amount of capital required? And as Tom said in the beginning, how does that compete with investing in an industrial or a telecom company? And it's, and again, I think for some of the smaller companies in the room today, that's a sort of a daunting challenge or a high bar to clear as the market ultimately allocates capital.
I think what was interesting about that, though, from BHP's perspective, is it was a sort of slight departure from very long cycle to more short cycle type of investment.
Yep.
And maybe that was part of not what went wrong, but.
So we have a few minutes. I'm sure there are questions. Philip, I think there's a microphone on its way.
Thanks. If I might, just two questions. One for Bert. I mean, can you just comment on how much permitting risk you take on, and also something perhaps about jurisdictional risk, and if there are places you will not invest, just a bit on that. And then another question for Tal, which might involve Olga as well. But do you foresee a time when so-called dirty things like coal become so uninvestable that bigger companies like BHP, Rio Tinto are basically forced to divest of their coal assets simply to be able to maintain a decent rating in the capital markets?
Thank you. Permitting risk, obviously try to avoid it whenever I can, but that in real life is in many cases not possible. So I would say that in 50% of our investments, we assume the permitting risk, right? For example, our metallurgical coal project, all of Downs, we've assumed full on the permitting risk. Now we've got the government approval 2 weeks ago, so that worked out well. We most of the time, the permitting risk is not binary in that you don't get it, right? You obviously only invest in jurisdictions where there's some history of mining and where there's an administration that understands the industry well enough, right? And you only go into projects where there's nothing controversial. So obviously you use all the usual risk mitigants. For permitting risk, you back a management team that has successfully gone through a similar permitting process before in that jurisdiction, so all of that. The delays, it's more, we find that permitting is usually, when you do all the right things and you avoid any controversial situations, it's usually not a binary risk, but you very often is subject to very significant delays. So I would say in 50% of our portfolio, we have assumed the permitting risk. In about 70% of the situations where we assumed the permitting risk, the permits were materially delayed. In some cases, extremely delayed, like we had situations where permit that the law should only take 2 months took 3 years, for example, because of all sorts of political constellations. So long story short, we do assume the permitting risk, but we apply a lot of risk mitigants if we assume it, including that the management team has a history in getting similar permits in the same jurisdiction, et cetera, et cetera. In terms of country risk, we usually, for us, the starting point is again the management team. So for example, we have a project in the DRC, right? Where by the way, quite a number of funds wouldn't invest, right? But the reason why we do that is because the management team who we backed has been twice entrepreneurially very successfully in that country. And by the way, that project is coming in so far, smack on time and on budget, which is usually not the case, I have to say. Now, that doesn't mean that we would have a disproportionate amount of our fund in high-risk jurisdictions. So I think from a portfolio construction point of view, I would say you have about 50%, 60% in, let's say, places like Australia, Canada, Chile, to kind of consider lower risk jurisdictions. Yeah. Maybe you've got 20, 25% in generally high risk jurisdictions. But again, when we go in and do that, it's because the management team has been successful in that jurisdiction before, and it stacks up with our internal risk analysis. If the size of the price is really worth it and we are backing a management team who have really delivered in that jurisdiction before, yeah, then we will consider potentially quite risky jurisdictions.
So on the coal question, I think the short answer is yes. I can see a time where larger companies divest of their coal assets under pressure from shareholders. I think it's a question of materiality. So we're hearing, for example, with Anglo, that as they grow the business, invest in the large copper project that they have underway, the percentage of capital employed that is in the coal area is declining, and that's good enough for the majority of investors. Something like Glencore, which has been increasing its exposure to coal over the last couple of years, I think may come under significant pressure to divest of that business, which, given that they are all such large shareholders of their own company, might have appeal to them because it will, I think, no doubt improve the rating of the shares. What we're seeing is there's an increasing trend towards gasification, though, which is quite interesting. So we're actually looking at the moment at companies that can provide that technology and provide the back-end engineering to allow some of the enormous coal reserves that are out there to be exploited in a way that is not detrimental to the environment, or is much less detrimental to the environment, and can still facilitate development in a lot of emerging economies.
More questions in the front here?
Philip Andrews, Resource 500. Listening to the comments, especially about the Tier 1 groups and then the strategies, especially the risk strategies, my impression is that in about 20 years' time, half of you guys won't have jobs or your departments will be closed down. And the reason why is over the last 15 years or 10 years, there's been very little funding in exploration, as everybody knows. And what's been happening in the meantime? The Chinese are picking up all the Tier 1 products. And the Chinese are developing them, and they're going to control the markets, as we see now with rare earths. And when the criteria of investment, especially in the earlier stage, is saying, no, we need our exit, and you're not even, it's kind of, where's the door in the house, and the house hasn't been built. It's not going to be there anymore. The Chinese, and the Tier 2 assets are not going to be able to compete with the Chinese Tier 1 assets. They're always going to supply cheaper and easier products to the markets. So the question, I suppose, is how does one holistically develop the mining industry from a Western standard of having the right criteria, but at the same time having that mutual support from, say, the investment side, shareholder side, the geologist side, and the mining engineer side, and so forth and so forth. It seems everybody's off in their own direction, and there's no real support beyond, let's say, the next group.
So I guess the question is, are the standards too high, and is the industry going to lose out to its biggest customer? Anyone?
Well, I mean, that's really an interesting debate that probably kind of exceeds the 1 minute, 4 seconds that we have. But I mean, as a start, I mean, funds like us, I mean, our investors are pension funds, insurance companies, healthcare systems. We cannot go to the casino with that money. Yeah. So if we lose that money, that has knock-on effects that are dramatic, right? The difference between whether large US institutional investors have a 5% rate of return, a 7% rate of return, are thousands of hospital beds for low-income earners, for example, in certain countries, right? So what I'm saying is this is not fund managers here sitting with kind of articulating unrealistic expectations, right? What happens with our money and the money that we send back to our investors or that we fail to send back to investors has significant knock-on effects somewhere else, right? So I think the returns under which we deploy capital, the requirements are what they are, and there's a good reason for that. That doesn't really answer your question. I think where the binary risk capital for exploration to find the next elephants needs to come from, frankly speaking, is from people who have a really large cash flow base in the balance sheet. I'm looking here at Olga, at BHP Billiton, for example. When a fund like us has a cash flowing asset, yeah, we sometimes use some of that cash flow and deploy some of that cash flow into high risk exploration, but only in a quantum of money that if we lose it, it does not undermine the overall equity returns. We call this, we kind of structure an asymmetric bet where we basically underwrite the minimum return with the cash flow and use some of the money. But if for Western governments and industry this becomes a strategic concern, whatever, like in Earth and maybe some other, frankly speaking, then also some governments may have to step in, because one cannot expect the private sector to assume a disproportionate amount of risk.
I think that's a good answer. Perhaps one more question. I know we started late, so.
One of the issues at this conference, as in so many recent conferences, is that the audience members seem to be always asking, what are the problems, what can go wrong? You know, whereas in mining, you go into these projects believing that you can get it right and get a high rate of return. So my question is very simple, and you don't have to specify the project, but could each of you indicate what the highest present rate of return, IRR, that you're getting from any of your projects? Because to me, that would be the definition of a good investment.
Yeah, again, so like, well, our most successful recently, and unfortunately not everyone is like that, and what matters is the fund return, is not the project return, because the winners have to pay for the losers, unfortunately, because we send the fund average outcomes back to our investors, right? So our most recent successful one was a 60-something% IRR liquidity event in Canada, the silver dip mine, yeah? 46%, not 60%. So that is a good outcome, right? But it's one project, right? So I have to think about it. What is the fund return when it's all done and dusted, and including those that have capital overruns and delays? So all of that. If a fund returns at 2 times money back over an 8-year time horizon, that is a pretty good outcome for a fund.
So your answer is 40 to 60% IRR.
Because if you don't, well, that's I would say we target like 35% IRRs, because 90% of the time when you target a 35% IRR, it ends up as a 20%. So this is why you just need to keep the kind of threshold high, because in the majority of cases, there are going to be negative deviations when the relative execution risk kicks in. Things take longer, things cost more, etc., etc. Mining has a very multifaceted risk profile when you assume the execution risk in real life, right? So you have to bake that in from get-go. So if you don't shoot for high return, you will, at the end of the day, not end up with an acceptable return.
Olga, would you like to comment on your publicly stated return targets or hurdles?
Well, the return targets, I think, is about 20%. But we are actually moving away from this, again, talking about single hurdle rate like IRR, doesn't allow you to capture not only downside, but as you said, also upside of the potential investments. And that's why we move into ranges, into probabilistic valuation, and trying to capture both downside and upside. And I don't think IRR necessarily does that.
And from a public market perspective?
Unfortunately, ours is harder to measure because we're in publicly traded equities. We're adding, we're selling, we're moving our position sizes around a core position sizing depending on the maturity of the company involved. So it's much harder for me to tell you that we have a target IRR or what our IRR on an investment is. What I can tell you is the focus on risk is not going to go away. A very wise fund manager early in my career once told me the first rule of making money is don't lose money. And there is a preponderance of ways to lose money in the mining space, which is why we so focus on it. And sometimes I think that my job is to worry. And it's only by avoiding landmines that you can end up setting your fund up for a long-term success. So I'm sorry, but that's not going to go away.
So perhaps allow me to wrap up briefly. I think I've taken enormous comfort actually from the presence and the comments of our esteemed panelists. There is indeed a strong bid in private equity for the early stage risk that many of the companies here today represent. That in some ways is an even more acute and underpinned bid than I've certainly seen in previous years. It may also be the only dollar of risk capital available, which does mean that the best projects will be the only ones who support it. I think, as we've heard from Olga, there is absolutely a framework within which the bigger, longer-term strategic investors are starting to allocate capital to the space, and certainly there's evidence that many of them, including BHP, have started to do that. So for both the private equity investors, whose returns are very much a function of their ability to exit at their theoretical valuations, again, that's encouraging. And perhaps most of all, having a representative from the public asset management space, where again, earlier to mid-stage development risk is being entertained and invested in, I think, is enormously encouraging. That certainly has been largely absent, as far as we can tell, for some time. Still lean pickings for investment bankers, but thank you very much for having us, and join me in congratulating our panelists for